And we are live again. There we go.
You got no juice?
Yeah, I'm good. Hey, Facebook, how's it going? So we are going to talk about a pretty historic day today. The stock market took an absolute killing today. So I want to talk about that and, as the title says, how to save your assets in a down market. Because a down market is actually, it's killer to, if you're trying to, whether it's savings, whether you're building wealth, working on your retirement plan, it's absolutely killer. So I want to go over a few things today and how to save you over the next 10 years, or in the next few years. So, of course, I don't know for sure if it's going to end up being a down market. We may have a huge correction. The stock market has been absolutely insane the last few years. It's been spectacular. So I'm not going to say anything about that. I'm just saying if we are going to have a down year, prepare yourself for it. Diversify and get into assets that are going to be based on cash flow, not on appreciation, which the stock market is based on. So let's do a little talk today. So this is what happened today. Negative 724 points in one day. Having an asset, and this is a gigantic asset. It's a stock market. 26,000 was the number that we're at. Having it lose nearly 3% in one day is absolutely insane. I can't imagine having investment that is so volatile. To me, I just don't think it's a good investment. So anyways, negative 724 in one day. So let's talk about where we're at for the year though. So we started January 1 or January 2, 24,824 is where the stock market was at. And this is our peak. I believe it was the end of January is when we peaked. 26,000. I mean, the stock market was absolutely on fire. Now, we are talking about the Dow Jones, just the average. Most retirement plans, they're not really seeing these types of returns. Everybody in Wall Street who takes advantage of all the new technology, they're the ones that are winning. So it's not even an 80-20 rule. It's more like a 95-5 rule. So top 95% of America is making the most amount of the money. But we've been in a decent market. So 26.6 was our peak. Today we closed at 23,957. So we're down 10% already from the peak of the year. I mean, think about that. In 2 months, we're down 10%. That's scary to me. And year over year, since January 2, we're down 3.5%. So again, I'm not saying that we're definitely going to have a downturn, but it's not looking pretty. A lot of factors that you and I can't control is what's affecting this. We good, Paul?
Get in, you zoom in and out.
It's zooming?
It's trying to autofocus.
Oh man, I'm too close. Maybe you can back it up a little bit. All right. So let's talk about this beautiful graph here. Let's talk about what the negative effects of a down market. So this trend is what everybody, when they're planning their retirement plan and estimating what's going to happen, this is the trajectory that they're always looking at. This is what 10% a year looks like. So if you have $100,000 invested and you get 10% a year compounded, meaning you put all your investment back in and now that new amount makes 10%, it goes up and up and up and up. This is what it looks like after 8 years. So let's just say that we're 4 or 5 years into this terrific upswing, 10% year in, year out. But this is what's going to happen. Whoa there. This is what's going to happen if you have a 10% down market. This is what's going to affect. So you were, after 8 years, going to be up here at about 215,000 from 100 in 8 years, which is pretty good. Instead, from 161,000, you're going to dip all the way down to a 145. So not only are you having an even year, you're having a down year. Your assets are worth less than they were the year before, which is not good. So now, instead of being up at 177,000, you're down here at 145,000 in the same time period. That is a 26% difference from where you would have been to where you are. Can you take a negative 26% hit? Most of us can't. It's absolutely devastating. So instead of being way up here, you're starting down here. Now, if you continue to get 10% year in, year out, you're going to be way behind. In fact, over the next few years, instead of 214,000, you're only going to have 175,000. That's if you continue to have up years. Well, what if you say, well, I'll just have a great year the next year, which, again, you have no control, but what would it take? So to get from a negative 10 back to where you should have been, you have to make 34% ROI on your money. Do you know how to make a 34% ROI? Most people don't. So that's going to be very, very difficult. So now we're just going to talk about how to fix it. The problem with this model, in my opinion, is that this is not investing. When they tell you to put your money into a 401k and then invest it in a stock market, invest it in a mutual fund, in my opinion, that's speculation. That is not investing. Now, there's obviously several ways to be a more sophisticated investor in the stock market. You can make money when it goes up and down. If you know what you're doing, most people with a retirement account don't know what they're doing. It's a sit and wait approach. It's a long-term investment, which is what they teach us, okay? But that's not investing. That's speculating. The reason it's speculating is because the only way to make money is if the stock market goes up. So let's talk about investing versus speculating. So when we're investing in real estate and other income producing assets, we are buying at a discount. We're counting on cash flow, not appreciation. We have total control of the property, which in turn allows us to create forced appreciation. For example, when I buy an apartment complex, that is sold on what's called a cap rate. A certain percentage of the profit is what I'm able to sell it at. So if I can go and increase rents, maybe I go and paint the whole complex. Maybe I go, add a feature, or maybe market rents just go up. That's going to make the value of the building increase, and it's something that I can directly affect. So those are some things that you can do to invest in a property. Speculating is simply purchasing at fair market value and hoping that it goes up in value. So, you buy it 100 and you hope it goes to 200. That's speculation. That is not investing. No, regardless of what your investment advisor tells you. So, again, in this example, in real estate, instead of 100,000, we're going to buy down here at 80. We're going to have that built-in profit margin. That's what we're always doing. That's one of the principles. And then again, you can, but in the stock market, you have to pay 100. That's where you have to start. You can't get a discount. Real estate, you're worried about cash flow. Appreciation is just a side benefit. It's a great side benefit because it's usually a large investment. So stock market, the only way to make money, again, is when the stock market goes up. And if it goes down, like it may in 2018, you might be in a lot of trouble. So what I like to focus on is income properties. Cash flow won't have a negative return. Now it can. You can really mess up an asset. You can you can really mismanage a property. But with the right pros, that's not going to happen. So you're not going to have a negative return. You may have a reduced return. We did see that in the downturn. Rents did drop, but rents didn't go negative. We didn't lose money. We just made less money, which is always a good problem to have, making less money instead of a negative return. And the reason is because we have control of the property. We control what happens to it. So I just want to leave you with a couple messages here. Number one, diversify. Don't leave all your eggs in the stock market basket, because as you probably learned in 1999, as you probably also learned in 2007, it can go down, and it can go down quickly. So diversify, don't have all your eggs in one basket. And then secondly, buy for cash flow, not appreciation. Okay? Like I said before, buying for appreciation is speculating. It is not investing. Buying for cash flow is investing, because it's going to give you a return that you can estimate, and it's going to be something that you can control. So that's all we have for today. We are going to be having a webinar on this very subject this Saturday, so stay tuned. I'm going to get the info out for that. We're going to talk about this problem, and then we're going to talk about several solutions and several different ideas that I have to help you make sure that you don't have a negative year, that you have a positive year. So follow me, Cashflow Kris, here on Facebook, and also you can find me on YouTube. My business page is Investors Edge Real Estate Group, and also I'm one of the AZ Flip Guys. Find us every Friday live at noon at AZ Flip Guys. So please like, subscribe, and share. Please share with somebody who needs to know this info. I'll see you guys next time.